This is a Momentum Media production.
The SMSF Advisor Show. Your expert insights into the biggest themes shaping the SMSF advice industry.
Hi everyone, and welcome to the SMSF Advisor Show. I'm Miranda Brownlee, and I'm joined by my co-host Aaron Dunn. Hi Aaron.
Hi Miranda, how are you?
I'm good. Big night after budget release.
Yes, it was. I was expecting to be in bed a little bit later than I was. So we've had another year ultimately where the expectation of super hasn't, I guess, transpired to the extent that we may have thought. There's some good in that and there's some potential not so good in that. And I guess we'll touch on some of that in today's edition of the SMSF Advisor Show.
Yes, we'll be talking about that plenty in the second segment of today's podcast. But there's been a few other things happening in the news as well. We've certainly seen a few court cases this year so far, and there's been a recent Queensland Supreme Court ruling which was around whether or not a notice of binding death benefit nomination was given to the trustee in accordance with the super fund governing rules. And we've obviously seen a lot of these cases sort of emerging more frequently.
Yeah, so this one of William and Williams is a Queensland Supreme Court case. And naturally, we have our High Court decision now that when we look at decisions that have been made around how death benefit payments are to be treated, we go to our Hill and Zuda decision. And ultimately that decision talked about the fact that when we look at how we need to understand how a binding death benefit nomination is created, we go to the SMSF deed. And it not only talks about the form in which that is created, but the format and the process that must be adhered to as well to ensure that that nomination is on foot. So there was a question of fact here around the timing of a couple of nominations that had been made and therefore the differences in those two nominations and therefore the validity of those were being put into question here. And the court naturally was looking at a range of previous decisions. If we think about the Cantor Management Services one that we've seen previously, that looked at the way in which the BDBN was served upon the trustee. These are all similar sort of things that we saw in this Williams and Williams case.
And we've also seen the ATO maybe considering some potential exceptions where there's issues in relation to SuperStream. We've obviously seen quite a few sort of issues arising with the whole SuperStream system. So I'm sure it's a bit of a relief with the regulator working quite closely with the industry and perhaps allowing some exceptions where there is things happening outside of the trustee's control.
Yeah, so we've got within the regulations, of course, the SuperStream requirements that must be adhered to in terms of, our 3 business days and so forth. But so we have, I guess, the way in which we need to look at technically how the law applies, but then we have practical challenges in getting these rollovers either into a fund or from a fund. And one of the practical things, for example, is where we have a payment that needs to be made, which is quite clearly well in advance of the fund transfer limits that can occur. And this in itself can then prevent or present problems for the trustees to try and get that benefit paid and therefore comply with the 3-day requirement within the regulations. So what, as part of ongoing discussions that the ATO is involved in within the sector, is to try and come up with, I guess, a more palatable outcome that's still in terms of the way in which the SuperStream rules comply in Reg 617, to ensure that ultimately we come out with solutions where we're not creating compliance issues just because there's some practical challenges in getting these rollovers happening. So if the process had started, but we maybe come up against some speed humps in making that occur, that in itself wouldn't prejudice it from being a compliance breach, and therefore potentially allowing for that payment to go through and then the auditor not having to raise that as an audit issue. So hopefully, we're identifying these issues and therefore hopefully we come up with some, I guess, practical responses to these, because by and large, people are trying to do the right thing to comply, but we know there are circumstances where that may not naturally occur.
Yes. And we've also seen, I guess, the consultation continue in terms of the advisor education reforms or what the government's doing around that. We've heard sort of some views from the SMSF Association who sort of suggested that this whole idea of an experience-only pathway kind of goes against why originally those reforms were put in place in the first place in terms of increasing professional standards and education for advisors.
Yeah, and I guess from the SMSFA point of view, it is, and it has been for a long time, trying to acknowledge the fact that when you think about those that can advise in the SMSF space, there's a level of specialization that occurs. And then on the contrary to that, I guess we're seeing the new FAAA, which is obviously the FPA and AFA that have now merged together, have really been advocating for a long time recognition of experienced advisors and the fact that we'd seen a huge attrition in the industry. So I guess what the government's trying to do is find a bit of a balance here. But, in terms of what the SMSF Association has said from its submission is that you want to also ensure, whilst that may be relevant, you want to recognize that there are pockets of this industry that have a level of specialization in it that you need to actually ensure that specialists are working within it. It's the old analogy, isn't it, where you've got general practitioners and then you have surgeons, and those surgeons go in heart and knees and all those weird and wonderful things. So it's finding the right level of experience and then finding the right levels of specialties into those areas, because you don't want a general practitioner advising on these things and then decides, well, actually, Miranda, you've done your ACL, so actually I'm going to get the scalpel out and start doing reconstructive surgery on your knee at the same time. It's that analogy when it comes to things like SMSFs. They are unique, have their own complexities. So you want to ensure that you're engaging with those that are suitably qualified to be able to provide that advice too. So that is the juggling act that the government is trying to balance here. And I certainly don't envy them, because they're going to have, I guess, competing demands on both sides of the equation.
It'll be interesting to see where all of that lands. And obviously in the lead up to the budget, we have seen the government leak out a few different measures. And one of those was the payday super, which has mostly been received fairly positively, although there are a few sort of concerns on the small business accounting side of things, whether small business will be able to keep up with that and whether they've got the right systems in place, and there perhaps needing to be some support for implementing this new system for paying super more regularly with wages.
Yeah, so ultimately, the challenge is going to be how good are systems going to be to enable payments to happen simultaneously with wages, on a weekly, monthly, fortnightly, however basis that is occurring. So the fact that there is a level of time to pass before this comes into play is significant, because it will allow for technology providers, those that do accounting software, those that interact with small business clearinghouse, other gateways for superannuation and wages and so forth, to adopt these rules. We need to see some legislation around it. We need to understand what parties would be excluded from it, like there is with related parties around SuperStream and so forth at the moment. So on one side of the fence, you've got people saying, yes, this is really good. Super funds saying that, and I don't know why it's starting earlier. And on the complete opposite end of the spectrum, there are a range of people that are the employers and in various sizes of those businesses saying, there's a lot of work to be done before these reforms come in play. So how we move through that in the coming years will be really important, so that we can overcome many of those concerns that have been raised so far. Valid concerns, but I think by and large, there's an element of saying, well, yes, this is the way it should be done. It's no different in terms of being able to pay super in a similar way that wages are being done. So we just need the technology to enable us to do that into the future. And we should be at a stage nowadays that we would be able to facilitate that.
Yes. And obviously some of the biggest kind of announcements have come from the budget this week, which we'll talk about now. So, Aaron, it was a fairly quiet night, I guess you could say, on the superannuation front. Maybe one or two more sort of measures compared to the October, but still, I guess, pretty minor sort of announcements. But there were a few sort of points that were clarified, including the non-arm's length income and the expenses and how that's going to play out.
Yeah. So as you said, it was probably a little bit quieter than we'd first thought. And now whether that was deliberate because the government has not yet finalised their objective of super. So they had made clear previously that they do want to wrap that up before the middle of the year. And that then obviously becomes a beacon for superannuation policy setting in the future. So part of that would suggest that if we take that on face value, that they would have therefore held off until they've finished obviously this consultation and then moving into legislation and then enshrining that objective of super either into the laws itself or into a separate piece of law. So therefore, as you said, one of the things that we did see that impacts self-managed super funds was the non-arm's length expenditure requirements. And earlier this year, and we spoke about it on our SMSF advisor show at the end of January, was that we saw a consultation by Treasury to fix the current disproportionate outcomes that occur when we have non-arm's length expenditure in respect to general expenses of the fund. So here we're talking about if we have accounting fees that should have been charged, for example, and they weren't charged or they were charged to a lesser amount than what would have been ordinarily charged to the client at large. So we did see Treasury initially come out with this factor-based approach where it would be targeted at 5 times the shortfall amount. And then we would have a calculation based upon that 5 times and the shortfall multiplied by the 45% and gives us an amount that we would then need to apply to the ordinary income of the fund. So what the government has now taken on board is they've reduced that factor of 5 down to a factor of 2. So instead of it being like a 225% loading, it's now a 90% loading. And therefore it is a win, I guess, in some respects for the SMSF industry. But I think by and large, the SMSF industry is not too happy about this because we've created something out of these measures that really aren't fit for purpose anymore. And therefore, whilst we've seen this peel back in terms of the percentage that is relevant here, and we've also seen a concession to adjusting for contributions. It's not really where we thought or where we would like this to be. In particular, that there's not a level playing field either because APRA funds are ultimately excluded from these provisions.
Yes. It is unfortunate still sort of that unlevel playing field, especially after all that consultation over so many years as well.
Yeah. And for me, that's we're 5 and a bit years since these laws came into play and we had working groups working together from legal, accounting, from APRA funds to SMSFs. From within those collective of associations and groups, there was a smaller group that was dealing with Treasury and the ATO and so forth on these issues. And this wasn't a topic or a mechanism to try and deal with this that was ever raised. And there have been multiple ways in which this could be dealt with. And as a result of that, Treasury has decided to go down this path. The feedback was naturally quite critical in the submissions from the consultation. Yet here we are. All they've done is given a concession by, in essence, reducing it by a bit more than half. And therefore, we are as a sector to sort of accept this as a win. I think many of us, like I said, don't see this as a win at all. There are various other ways in which we should do it. One of those is to actually repeal the legislation because a lot of the issues where this started are now fixed. And you've got other aspects of the SIS and tax laws that could actually deal with the issue.
Yeah. The other big talking point's obviously been the $3 million threshold. And we did see, based sort of on the revenue estimates, it is still the same sort of amount of revenue they're expecting, which sort of suggests that they are just going to continue with the same calculation method that they proposed previously, which may mean that we will see those unrealized gains taxed.
Yeah, so this is an intriguing one as well, because as you said, Miranda, initially the forecast was sort of $2 billion of revenue to be collected in its first full year of operation. And that number in the budget has increased to 2.3 billion. And I think that recognizes the defined benefit pensions and stuff as well. So we had consultation with Treasury, in the lead up to the budget, and, there was an opportunity to express various concerns and views in respect to those measures and the impact on the SMSF industry. From that standpoint, I think the fact that the government has been fairly broad in their response here, shows that how much attention they've really given to those concerns is of concern, I think, to us. You touched on the unrealized capital gains there. That is a huge, still live issue that needs to be resolved. They've been fairly forthright in that we're trying to find something that is very standard across APRA funds and self-managed funds. Yet we know that this is by majority going to influence self-managed funds. And to call it out, we have in the NALE consultation that we were literally just talking about, two different sets of circumstances for an APRA regulated fund and a self-managed fund. So in this respect, why do we need to have a uniform set of principles for determining earnings for APRA and SMSF when they're quite clearly in other elements that are inside this budget, they're creating a different playing field for APRA funds and SMSF. So yeah, there's a few really frustrating aspects to it. It doesn't mean that the government won't still listen, but the natural progression from here will be to drafting the various bills, and then that will give further ability to provide feedback and consultation. And then if we can't sort of get through there, then there's naturally going to be a lobbying process to go through, in particular at the Senate level, to raise those issues as well. So I think, we're going to continue to fight the good fight on this, because, whilst a lot of people might say, well, there are people with $3 million, we know of the examples and we see them getting raised regularly, farmers and those sorts of things who, yes, they may be asset rich, but they certainly don't have the cash flow there to be able to pay these liabilities when these liabilities are unrealized in the first instance. So yes, I think there'll be a fair bit more water to go under the bridge. The budget didn't really add anything to what we already knew. So at this stage, we kind of just need to wait and see, and hopefully we get an opportunity to have further dialogue with Treasury to, flag these issues further.
Yes. And there obviously was a bit of relief that we didn't see any freeze on the transfer balance cap indexation, which was only something that was speculated, but it is still a relief that people can now plan ahead and have, I guess, a little bit more certainty that it will just go to the 1.9 as previously, as it is intended anyway.
Yep. And I think the Minister, Stephen Jones, had briefly indicated that they had no real expectation that they were going to make any changes to that. And similarly, they said that around things like Div 293. So we saw the phase 3 tax cuts sort of go through. There's been a lot of discussion about that as well. And therefore the opportunity could have been that he maybe dropped the threshold for Div 293, but he did come out and say on a couple of occasions, like I said, there was no expectation from Labor to be influencing those thresholds, and therefore they've stayed true to their word on those couple of items.
There was also no mention that the minimum pension reduction would be continued, so that will cease on 30 June as planned.
Yeah, and again, we have seen through legislative instrument, I guess, changes to the regulations year on year on year. And I think last year we probably got one extra year than we would have otherwise been entitled to because of the federal budget last year. So that election promise trying to buy votes. So the reality is that, I would be now expecting, I don't see any last minute changes to this. Those 50% reduced minimums would go back to their ordinary levels, which therefore means from an advice point of view, you need to be ensuring that your clients are given consideration to the ongoing liquidity issues inside your SMSF investment strategies, whether it's to pay benefits and other fees and expenses as and when they fall due.
And unfortunately, we didn't see any further updates on what they're planning to do with the SMSF residency changes. Obviously, they did say in the October budget that they were going ahead with them and were going to defer, but they haven't really given any update on what's happening with that. And there still hasn't been any mention of whether they're going to consider the amnesty for legacy pensions either.
Yeah, so the residency rules one, as you said, Miranda, in the October budget 2.0, I call it, they last year did change that 1 July 2022 start date to being some point in the future, the financial year after all assent has been received. And in reality, it's a fairly easy fix because we're seeing central management control, the 2-year window move to a 5-year window, and then we're seeing a repeal of the active member test from that residency, those 3 limbs to the residency rule. So in a perfect world, we'd love to see the government look to address those as soon as possible and therefore let the industry move on. The legacy pensions one's a bit more interesting because what we haven't seen is any further announcement on that issue. So the government has indicated that they're still committed to doing that, but we at this stage still await any further clarification. Now, what's interesting, there was consultation naturally between the SMSF Association and the Treasury about those $3 million better targeted tax concessions that we spoke about before. And it was highlighted in those meetings that there was an unresolved position in respect to this issue. And given that we've got defined benefit issues in this calculation, it would actually make sense to try and get this issue fixed now or get it fixed before the introduction of these measures, because it might allow for some of those people to unwind those arrangements and therefore fall into either the new regime, subject to how that ultimately transpires, or they would, be able to remove some of that money from the system as well. So there's actually a bit of motivation, I guess, to try and get this matter resolved from, I guess, the SMSF industry, but also in the context of the way in which the law is currently designed and how it's going to be designed in the future for those with balances over 3 mil. So at this stage, we have nothing, but there has certainly been an awareness put to Treasury about that issue as well.
So definitely a few important points of clarification in the budget, and also a few things we're still waiting to hear more about. But if you do want to hear more about some of those measures, you've got an upcoming fundraising event, which you might like to tell everyone about, Aaron.
Yes, I do, Miranda. Thank you. And you've been roped into it as well. I had an idea. So a good friend of mine in the industry, Hepburn Rogers. So she's an SMSF specialist, registered tax agent based in Canberra, been involved in the industry for a long period of time. So she's 41 years of age and has been diagnosed with an incurable brain cancer. And she needed to get some treatment. Some of that treatment is not available in Australia, and needed to raise about $50,000 to get to Germany to have that treatment to help prolong her life. So, you kind of go, I'd like to make a donation. And then it got me thinking, well, how can you actually make a much bigger difference and build a bit of a dent into that money that she needed to raise? And so anyway, I got on the phone and started, I guess, bouncing an idea off a few people. And most importantly, the response I got was an emphatic yes. And from that was born this event, which we've called SMSF Hero, which is a fundraising event for Brooke. And as I said, you're involved. And I've got myself, Meg Heffron from Heffron, obviously, and Scott Hay-Bartlam from Cooper Grace Ward. The three of us are presenting over a 3-hour live streamed event, and a special thank you should also go to Momentum Media as well, because when Helen got in contact with Momentum, again, that was a resounding yes to be supportive of the event. So we'll be live streaming, and Miranda, then you will be moderating the Q&A as well with both Meg, Scott and myself. So it is a great opportunity to get and understand more about these issues, I'll be giving a regulatory update. We'll naturally be discussing this NALE issue in more detail and what it means, what actions need to be taken before 30 June. Meg's going to deep dive into this $3 million threshold, and Scott is naturally going to be looking at the area that he is one of the most recognized experts in, and that is around death benefits and the payment of superannuation death benefits. So it is $100 to attend. We want to get at least 200 people. It gives us $200,000. 100%, I should say, of the proceeds go entirely to Brooke. Everyone involved is giving up their own time to do this. So I encourage you. It's the best value of CBD. You can get 3 hours for $100 plus GST. So go to smsfhero.com and you can find out more and to register.
Yes. Hopefully that does help Brooke raise the funds she needs a lot faster. And as you said, Aaron, it will be very valuable content as well. So you can just jump on the SMSF Advisor website in the events section to find out more information on that.
Excellent. Well, Miranda, as is always the way, if anyone has any questions, suggestions for topics or suggestions for speakers, how can they get in contact with us?
So just get in touch at editor@smsfadvisoronline.com.au.
Well, thank you once again for joining us for this week's podcast on the federal budget. Thank you for joining us, and we look forward to seeing you at our next SMSF Advisor Show. Take care and bye for now.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Are you feeling the strain of high mortgage repayments? Refinancing with Finny Mortgages can help you save big on your home loan and ease the burden on your finances. Our team of expert brokers specialises in helping Australian investors find the best possible rates. Refinance with Finny Mortgages today and start saving. Visit finny.com.au or call us now at 028 866 2444 to chat with an expert.